Hey everybody, Tom Gentile. Welcome to a special webinar tonight. We do this webinar once a year. It's titled How We Trade Earnings Patterns with 100% Historical Accuracy. We're glad to have you all here. What a great webinar we got on tap for you over the next hour. We're going to discuss very quickly, talk a little bit about my 2017 market outlook. We're going to get into a little bit of the earnings patterns, but I really want to teach you a strategy that we find works much more often than not in earnings. And here's the best part. You don't even need to get an idea on direction, because direction is one of the hardest things to pick when it comes to earnings. But we're going to show you how we can create option trades that, like it says on the screen there, with 100% historical accuracy, where we're looking for patterns that occur. And these are not patterns that are calendar patterns. All right, this is a completely different pattern. I'm really excited for having everyone here. You're going to learn a lot. And you're going to really learn how to trade these earnings patterns like a one percenter, because that's the key. The key is take something that everybody else in the world is frustrated with and learn to trade it like the few people that know how to trade it properly and consistently. And so that's what we're doing tonight. With me tonight is Mike Wade. Mike, good evening.
Good evening, Tom. Good evening, everybody. It's good to be here.
Glad to have you here. And backing us up in the room is Jay Harris, who's in nearly every one of our webinars. Jay, good evening. How you doing tonight?
I'm doing well, Tom. Thanks. How about yourself?
I'm great. We started out the morning with, the markets started out the morning kind of on the high side, and then just kind of fell off during the day. And I've had some bearish trades on that I've been looking to get out of by tomorrow. And those finally started looking really good. And so pulled those off. So now it's all about jumping into and looking at earnings and looking at some more non-directional stuff, which is what we're going to do here tonight, guys. Before we continue, let me just point out the disclaimer you see here on the screen. Our sessions are being recorded. This is a recorded session. It will be emailed out to every single one of you. All right, so you'll have access to this to view this recording once again. You can ask questions in the Q&A box, but let me warn you, there's a lot of people in here tonight. All right, so if we don't get to your question, I'm going to apologize to you right now, because we just will not have time to take every question. We'll take the most popular ones. I'll even give you an email address, our email address, if you want to ask us questions after the event, in case we didn't get to your question. All right, last but not least, the disclaimer you see here. Again, you can read this from beginning to end. It is in every one of our webinars that we do here at Tom's Trading Room. But let me just point out three things to you. Number one, stock and options trading has large potential rewards, but it also has large potential risk. Number two, myself, Mike, Jay, and everyone associated with Tom's Trading Room, we're here as your educators, all right? We are not brokers, investment advisors, money managers, all right? We're here to educate you on what we do. And number three, you need a broker to trade with. You must meet certain requirements, and everything we're going to talk about tonight is in US dollars unless noted otherwise. Now, our focus tonight is I'm going to talk a little bit about market outlook, and I'm going to look at Nvidia. There's a reason I'm looking at Nvidia is because I was on CNBC a couple of days ago, and I talked about it. So because it's out there, I'm going to go ahead and tell you how I found this, because CNBC did not give me the time to tell them how I found this. Right? It was more about fundamentals. But for me, we are rules-based traders. All right? Keep that in mind. We don't look at trades and pick trades based on what we think or what others think. I got to tell you guys something. Jay, I got an email from somebody a couple of days ago that said, you and it was another market analyst need to get together and get your head straight, because you think Tesla's going up and he thinks it's going down. You guys need to talk more. Well, I got an answer for that person who's probably not on this. He's not on this call tonight. And that is, let me tell you something. I'm a nice guy. I'm one of the nicest guys in this business you'll ever meet, behind Mike Wade. But here's the thing. I will never, ever take a trade based on what somebody else said. I don't care how many times they've been on TV. And I don't want you to either. Okay. So what we do, what we teach you tonight, I want you to form your own opinion and to really, my job tonight is to educate you on strategies that nobody else knows exists. And I want you to decide whether those make sense for you. That's the big thing I'm trying to say there. All right. So in my trading, I mean, I will mute CNBC. I will shut the phones off. I won't talk to anybody when it comes down to me trying to decide when I'm pulling the trigger on a trade. The only thing I'm looking at is my rules, spotting opportunity, creating low risk trades, and then managing those trades. And so tonight I'm going to show you how we spotted that opportunity in Nvidia. We're going to talk about finding earnings patterns with 100% historical accuracy, regardless of market direction. Then we're going to talk about low-cost opportunities. Now, straddles are something we're going to discuss. They're a little more expensive than your average call or put, but you're going to find that what we're looking for is something that's going to be far less than you might think, and why we insist on taking profits within 10 days or less on this particular strategy. Okay, so let's talk about my January outlook. All right, we're coming into, first of all, it's 2017. We're coming into a period where we've got a new president. He will be sworn into office tomorrow. And, think about this for a moment. Long-term history tells us that a president's first year of their 4-year cycle is typically the hardest on Wall Street. Now, I'm also going to tell you that no one ever thought Donald Trump was going to get elected. Because if any of us in this room did, we'd have put money down when his odds were like 50-1. And that was about a year ago. And so now here we sit, and he's about to take the oath of office, put his hand on the Bible, and become the 45th president of the United States. Because the pundits and the media got it all wrong, and also because a lot of folks on Wall Street got it wrong after November 9th, because they thought the market was going to crash, and it didn't. By the way, if you looked at the money calendar back in November, we had patterns going up, and it didn't matter who was going to be elected president. It was time for the market to spring, and the least area of resistance was up. But what I'm telling you is this: if they got it wrong on him being the president, if they got it wrong on the stock market crashing if he got elected, then what's to say that the first year of this presidential term is going to be a down year? For all we know, we're pulling back right now, and once he gets elected into office, we may turn around and start going green again. And if you look at this calendar, it really states the same thing. We've had a lot of uncertainty for the last couple weeks. We started getting light green. Tomorrow we go back into the 90% area, and that just basically means 90% of the stocks that I'm looking at that are giving me high probability patterns are bullish patterns. This lasts into February. I'm letting you know that right now. So my January/February outlook is, based on history, looking pretty good. So when we get into individual stocks, and because we want to teach in here really about an option strategy so much, I'm going to talk about this one individual stock, and then we're going to move into trading regardless of market direction. So on CNBC, I had mentioned Nvidia. I had maybe less than 60 seconds to talk about Nvidia. You know what I talked about? Because you can't throw numbers to CNBC unless you're standing there and you've got a digital pen and you can actually draw on the screen. I can't do that from my office. So what I had to do was talk a little bit about Nvidia as a company, that it's passed, the GeForce card. That's been one of their biggest revenue pieces, is the GeForce card. And the GeForce card, by the way, back here, that's what I'm running this with. I got two GeForce cards sitting in that server that I got below me that power one of my computers. Fantastic graphics cards. That's their past. Their present, presently, we were discussing Nintendo Switch. Now, Nintendo Switch is a brand new entertainment system that Nintendo's rolling out, and already the pre-orders have been sold out. This is going to be the hot game of the year. The only thing Nintendo screwed up on is they weren't 3 months ahead, because if they were, they would have totally been the Christmas present to buy. But they weren't. So their pre-orders have sold out here in the U.S. They and what does this got to do with Nvidia? Well, here's what it's got to do with Nvidia. Nvidia has the brand new next generation graphics chip that propels this Nintendo Switch entertainment system. Okay, and then you've got the future. The future of NVIDIA. The future of NVIDIA isn't the graphics cards of today or even the deals that they're doing today. It's the deals that they're doing tomorrow. They were at the CES show a couple weeks ago. They won over 24 awards for their product line. And the big talk, all right, well, the big talk at CES was the Faraday Futures car that just wasn't to be. I mean, they tried to make it drive away by itself by the push of a person putting their finger on the door, and the CEO or one of the officers put his finger on the door. The car didn't move at all. So that was the biggest talk at CES. The second biggest talk at CES was the fact that Nvidia is getting deeper and deeper into AI, that's artificial intelligence, and deep learning. Basically means that their cards and processors, they are working on the continuing to enhance the learning capabilities of these cards. So what does that do? That puts more Nvidia products in a smart car, in a smart home, and now they're even talking about smart cities. Stock tripled in value last year. But I want you to keep in mind something, all right? As traders, we're not investors, okay? Mike and I are going to teach you a strategy that we're really in these particular trades on average about 10 days. There's, each particular stock might have its own fingerprint, meaning it has a different entry date and exit date. But an average of 10 days, that's not an investor. That's a trader. And if you look here at what I've got on the screen, this is what I couldn't talk about with CNBC because I ran out of time. But NVIDIA's averaged just below 8% heading up into earnings and about 13% average after earnings. How do I know this? Because I have the data and I've looked at it. And I know that over the last 4 earnings cycles, we've had over 4.5% moves in the week heading up to earnings. And the day after the earnings announcement happens, we've seen an average of a 13% pop. So you take that, throw the fundamentals out, okay? Because that's just talk. But take the data that you see here and take the fact that these guys have beat their earnings estimates for the last 8 quarters. And that tells me that there's a possible directional trade here, which would be entered around week 2 of February, and you'd exit on the 16th at the market close. Why the 16th? The 16th is the day after the earnings are announced. So what kind of a trade would I do here? And by the way, let me throw a poll at you guys right now. All right? Let me throw a poll out here because part of this is, it's not just me and Mike talking to you, but we're going to throw a couple interactive questions out at you so that you can talk back to us. So my very first question to all of you is this. What is your options experience level? Okay? Are you a complete novice? Do you know enough to be dangerous? Or are you already trading and even trading straddles like Mike? All right, that's important to know too. And now I'm getting a lot of answers that are popping in right now. And keep in mind, you would choose one of these, click on one of these and click submit. And what's going to happen is your name will not come up. This is going to show me an overview of the entire room. There's no names that are going to be shown. All right. So your answer is not going to be a stupid answer if that's what you're concerned about. What it helps us do is get a level of the room and get an idea of who we're talking to in the room. So I'm going to close the poll in 3, 2, 1. Poll's closed. Mike, let's look at some results. So our option levels and even straddles we're going to talk about here is complete novice. 15% of the room is complete. Knows little about options. To none. 65% say they know enough to be dangerous. Now that's the folks who know something about options, but maybe are not utilizing a long-term strategy like spotting opportunities, like we're going to talk about tonight. And then 20% of the room is already trading like you, Mike. So
hey, awesome.
You got some cheerleaders out here. So I want to tell you this, the 20% of you that are in this room, I want you to go on the Q&A tab right now and tell us how you've been doing trading straddles like Mike, if you have been trading the straddles like Mike, because I do know there's some people in the room that already trade like Mike. So let us know. Throw in a quick sentence or two in the Q&A box, because we'd love to know how you're doing. Now, let me close this poll up and let's continue on. So what kind of a trade would I do here? 65% of the room should know the answer to this. In fact, most of you should know the answer to this. And that is a call option. And before I even go into that, well, yeah, let's take a look at this one. So a call option is going to look like this, right? Limited risk, unlimited reward. Honestly, I don't think there's such a thing as an unlimited reward. To me, an unlimited reward is something that outlasts you. All right. So if I invest in something and I plan on holding it through my death, to me that's an unlimited reward. All right. If I pass that on, but for options, to me there is no such thing. What there is there's fantastic upside until you take the trade off. That's what I see. Right now, these Nvidia February calls that we're looking at, the 100 calls, this was pulled off of just a couple days ago. The risk on this is a combination of price and time. We know that because if the stock goes up, great. We see rewards of 500, 1,000, 1,500. If we get up to around 122 on Nvidia, 1,500. But stock goes down. The most we can lose is what we put into this trade, which in this particular example was somewhere around $700 based on this call. Now, what happens if we go nowhere? Well, that's the time risk, because as we go nowhere, this option has less and less time to actually become profitable, and therefore it becomes worth less. And you could, in fact, stay at $100 a share and lose everything on the call option. But I can tell you the majority of the risk is 50-50 at this point. It's 50% price, it's 50% time, because it is a directional trade. All right. Now, what we try to do is we try to find what I like to call abnormalities, inefficiencies in the market to help us find times when the market's not just kind of gyrating back and forth, what a lot of people like to call the random walk theory. Right? Random walk theory has actually been disproved in a lot of areas because random theories involve non-emotion. Like, for instance, when you throw dice on a table, that's going to always give you a random theory unless you have a pair of loaded dice. All right? If you have dice, probability will eventually take over. There may be short bursts of sevens and short bursts of 11s, 12s, goose eggs that come up. But over the long term, it's going to follow the probability curve. Now, the reason that doesn't quite work with stocks is because we have the element of fear and greed built into stocks. Because every time you and I make a decision to buy or sell something in the stock market, we're putting money on the line. And money is an emotion. The more you put out, the more emotion you have. And the more likely you are going to be very greedy or very fearful or even both. So keep that in mind. Now, I want to do a real-time example real quick. So let's go over to, I was looking at IBM. So let's say IBM, IBM actually announced earnings today. So I'm going to, without doing anything, I'm just going to look at what the call options would have done with IBM. Now, first of all, a straddle, for instance, which we're going to talk about in a moment, is a combination trade. But let's say I wanted to simply buy, what was the trade with 1 day to expiration, for instance? What was the calls for IBM trading at, the at-the-money calls? Well, they were trading around $2.62. That was for the 167.5 calls. Those are slightly out of the money. So if I bought those, let's go ahead and hit the risk graph here. And let's take a look and see what this looks like. So there's your trade. There's your risk if it goes down. Now, earnings came out already, and we know the stock's going to have to pop by tomorrow. The stock's going to need to be, up in the, really, if you take a look here, 167.5, got to be above 170 by tomorrow. This is a 1 day option. Got to be above 170 by tomorrow. All right. So Where's it at right now? Well, you know what? I didn't plan on doing this, but let's do it anyway. MarketWatch.com. MarketWatch.com. I'd love to go to my tools and do this, but MarketWatch.com is going to show us what the trade did after hours, really quickly, without me having to make a whole lot of changes. So I click IBM. Take a look at this. 162.80. This is the after hours chart. So here's what ended up happening. IBM it beat its estimates. Look at this. IBM hits a 52-week high after beating estimates. Yeah, that happened for about, 10 minutes as it popped to the low 170s, and it came roaring back down, and now we're at 162.80. So what do you think is going to happen to that option tomorrow? It's probably going to be worthless. If we end up opening where we're at right now, there's a good chance we will, then this $2.62 investment, or trade you want to call it, is going to be worth about 90% less on the open. So that's one thing we could look at. How about, let's try something else. What about trading both ways? And that's the topic of tonight's conversation with you. We want to talk about something called the long straddle. So a long straddle is a way of being able to trade both ways regardless of what the market does. It involves an at-the-money call and an at-the-money put with the same strike price and same expiration date. Okay? Limited risk and greater reward to expiration. So I want to show you how we build one, and we'll take a look at an example of one or two. So let's go back to the graph once again. And this time what I'm going to do is now we know what happened with IBM. So now we're all a little bit jaded in the room because some of us go, well, we should buy a put. Of course we should, but no one knew that before I hit that button. Maybe some of you did, but most of you in the room didn't. So let's go back to IBM, assuming that we're going to buy a straddle, which again is a at the money call or a near money call and near money put. So I'm going to do the 167.5 call and put together. Let's go ahead and click on risk graph. Let's see what this looks like. So here's our trade. And I want you to notice something. What just happened to the risk graph? For those of you that are new to straddles, if the stock goes up, we go into the profit zone. See this black line right here? This is break even. Anything to the right is profitable. Anything to the left is a loss. We go to the right. If we go up, profit. But what if we go down? If we go down, profit too. But where is the risk on this trade? The risk is in the middle. If we go nowhere, if we stay in the break-even lines by tomorrow, 173.80. That's the blue line you see here to the upside. The downside break-even is about 161. Looks like about 161 and change. All right, and we have that information. There it is. 161.63 is the downside break-even. 173.37 is the upside. What are we doing? We're buying the 167.5 call and the 167.5 put. Now, there's a lot of reasons why I would not do this trade. Would any of you in the room care to comment on why I would not do this trade or why you would not do this trade? Just obvious reasons. What do you see? Put it in the Q&A box. Too expensive. Mark says too expensive. Joe says IV crush. We're going to talk about what that is in just a moment. Overpriced. High vol. Requires a lot of price. Lack of time. Great answer, Robert. That's what I was really looking for. See this? 1 day to expiration. 1 day to expiration. That's crazy. Now, I want to go back and, some of you might be thinking, but wait a second, Tom. That stock is down tonight. The stock's down to, what price is that again? 162.80. Yeah, here's the problem with 162.80. You know what it is? It's still not below the break-even 161.63. You still end up losing money on the trade. It has to move a lot in a short amount of time. That's the problem. Look at the IV, which someone said IV crush, 84. Okay. Now some of you may be listening. You're hearing the words IV for the very first time. Implied volatility. All right. So let me ask another question. Who in the room knows what the VIX is, but doesn't know what implied volatility is? Just if you know what the VIX is and you don't know what implied volatility is, just put a Y or say yes in the Q&A box. so I know who I'm working with here. All right. You know what the VIX is, but you've never heard of or don't understand implied volatility, because I'm going to make it really easy for you. Okay, we got a lot of yeses in the room. So here's the thing. We know what the VIX is, and I'm going to show you what the VIX is. The VIX is a chart of implied volatility. So if I were to come back over to this IBM, let's go over here to stocks. Let's go to charts, and we're going to look at VXX, which is like the VIX. It's pretty much the same thing. VXX is a chart of VIX implied volatility. And as you can see here, look at the VIX implied volatility. It's going down. Our volatility, the VIX, has been the lowest it's been in some time. All right, we're trading down here. Future volatility is trading just around 20. But I want you to think about this for a minute. So this is the volatility of the overall market. That's when you look at VIX or you look at VXX. Volatility of the overall market. Now, compare that to the volatility of IBM. 84.78. That means that this particular option, all right, or both of these options for this straddle are trading at 4 times the average implied volatility for the stock market. So those of you that said IV crush, too expensive, some of you might not even know why it's too expensive, but now you do. You look at that number right there. That number tells you whether options are cheap or expensive when you compare them to the market. Okay, it's one way of doing that. So I wanted to tell you about that simply because you could trade both ways. And here's an Nvidia straddle. But the problem is, once again, is that, and this is a February straddle, so we do have more time. But regardless of whether the price is expensive or cheap, we have double the risk here if we hold this all the way to expiration. Is that not right, Mike?
Oops, I was muted. Yes, absolutely. Definitely.
So what we've got to do is, I mean, you know, and what I'm talking about right now, guys, is that some of us hear about this straddle for the very first time and we think, oh, wow, I could do this on anything. I don't have to pick market direction. The problem is that probability-wise, if we're going to go down that road, let's go down that road. The probability of a straddle working out, if you just simply buy it and you hold it to expiration, is less than 33%. Okay? That means 1 out of 3 of these will work, and you don't even know if the one that works is going to actually pay for the 2 that you lost money on. So, again, there's reasons why it's a bit frustrating, but let me tell you something, and we're going to say this more than once. The frustration for many becomes opportunity for the few. All right? Keep that in mind. So the problems with the straddle are this. What are the biggest risks? Delta risk, that's lack of direction. Theta risk, that's your time risk. And vega risk, especially if you go into an earnings report, you could have volatility risk against you. And again, the problems for many become the opportunities for few. So at this point, what I want to do is I want to introduce Mike Wade. And the reason I want to introduce Mike Wade is that he trades these straddles and these earnings breakouts absolutely, completely different than 99% of straddle traders on the planet. So, Mike, welcome.
It's good to be here, Tom. I am indeed a straddle trader. I didn't start off that way, though, Tom. As you know, when I first started trading, I used to like to sell naked puts. When I came to Optionetics, well, actually, I didn't have to come to Optionetics. I learned in 2000 how dangerous selling naked puts can be. So I have a sort of an A+++++ personality, ready, fire, aim, and I avoided straddles partly because they weren't sexy enough, they didn't move fast enough. 1 out of 3 worked, as Tom just mentioned, and I just wasn't interested. And then once I started to take a look at the inner workings of a straddle and really understand how they make money and how they lose money, and with a focus on how they make money, I was able to come up with a system that I've been using, actually teaching for the last couple of years, and we've had amazing success with it. And it's really all about trading a part of a value of a straddle, which is called implied volatility.
So, Mike,
So Tom,
you're gonna talk a little bit about the solutions, all right? Because I've kind of posed the problems. You're gonna talk about the solutions. You're gonna show everybody your trades for 2016, and you've got a trade or two that you're gonna be sharing with them tonight, which is a real time example you're looking at going into this earnings season, right?
absolutely, yes, absolutely,
Cool.
yeah.
So, talk about how you got to the point where you developed this.
Well, the reason what got my attention is that picture over on the right. This heartbeat pattern. Those red lines there, they look like heartbeat patterns or waves. I call those red waves. And I'm looking at a pattern. Trading is, be successful at trading, it's really about identifying patterns that are historically present and likely to continue into the future. So looking for history, looking for patterns in history, and then developing strategies that make money based on these patterns. These patterns are very, very predictable on certain amounts of certain stocks. So I love the heartbeat pattern. And notice, as Tom said before, that after earnings, and he demonstrated, he talked about it, that after the earnings announcement, the implied volatility of the red line just tanks. And that's a danger. When you're buying a straddle, that's a danger. That's one of the things that, IV crush that can kill a straddle if the stock doesn't move enough. So it's a little treacherous. So I was thinking, wouldn't it be kind of cool to be able to figure out a way to profit on these red spikes? So this has been a long conversation for me, and I've been working with Tom's developers, and we've come up with some really beautiful scans that go out and detect these patterns and also tell us the optimal time to get in before the earnings announcement. So it gives us a timing. Maybe it's 10 days, 2 days, 14 days even.
Right.
So it's sort of like, Tom, it's sort of like a scalping at a concert, at a ticket, getting a ticket at a concert.
And that's really the whole gist of the. And again, you're getting ahead on the on creating the efficiency. But I think the first thing that people need to understand is the actual strategy itself. And you said it. What we're doing is, imagine the Super Bowl's coming up here in the next couple weeks, and ticket prices are already $10,000 or more per ticket. Imagine, Mike and I going out and buying a couple of tickets and then hanging out in Houston, and we're going to try to sell these tickets. You think we're going to get more money if we sell it before the actual event or at halftime?
Yep.
Simple.
Probably a half hour before the game start. Well, we could sell them for 2-3 times.
Yeah, as soon as the planes fly over.
That's right.
As soon as the planes fly over, that's the peak right there. After that, the ticket prices are only going in one direction, and that's down.
They're going.
And so before we move any farther, I want to throw another poll out to everybody. So some of you had popped in the room here recently. What do you know about straddles? All right. Until this evening, till I started talking about them, what do you know about straddles? How many of you have either never heard of them, have heard of them but never traded them with mixed results, or trade them the way Mike does? And so this is a little different. The first question I asked was more geared toward options, and this question's geared more toward actual straddles themselves. And so we've got 55% of the vote already in, Mike. Once that number gets to around 60, I'll go ahead and stop the poll. So I'm going to close the poll now. We'll take a look and see what we got here. And this looks much like a bell curve. So when it comes to straddles and really even trading them around earnings, 5% never heard of them, 53% heard of them, never traded them, 40% traded with mixed results, and 2% trade them the way you do, all right, which is what you're about to show. And you know what, guys? Yes. That's the way we like to keep it that way. We don't like to have more than 1 or 2% of our group trade them this way because, again, it's kind of like, the best way I can explain it is, if I've got a lake and I got a certain spot that I go fishing. Problem is, if I tell too many people where my favorite fishing hole is, those fish are going to be gone. And that's kind of the same way when you look at something like this. This is a particular strategy where there will never be a publication that goes out to thousands of people on this, and there will never be too many people that understand that really understand these like masters, because unfortunately it ends up ruining the trades. And Mike and I both trade earnings, and we'd like to continue to trade earnings profitably. I know you would, Mike.
Absolutely, yeah, yeah. We,
So
we, we don't want everybody doing this strategy.
what we are going to do is we are going to move all of you up into you're going to learn something brand new in terms of how to trade these straddles. And there's the way that you may have learned it, and then there's the way that we do them. And you'll see, and we'll talk about both of those as we move on. So let's go ahead and move on. So Mike, why don't you talk a little bit about why are earnings announcements frustrating to most people and just profitable for a few?
Yeah, well, it comes down to what you said before, Tom, and I mentioned it again, is that straddles, they sound good, right? You buy a call, make money if the stock goes up. You buy a put, make money if the stock goes down. As long as the stock moves, you make money. It's not that simple. It's actually, if the stock doesn't move, you lose money. So that's something that most people that trade straddles don't know. They're not educated enough. They don't really understand the idea of time decay and the impact of volatility fluctuations and the like. So,
Hey, well, back up for a second now. Look, forget about straddles for a moment. Just think about earnings announcements as well. You know why most people are frustrated? Because they can't pick price. I mean, here's a good example. IBM announced earnings, positive announcement, up 3%, and the stock popped, and now it's down. And there's people that got into this thing after hours, thinking they were going to be ahead of the curve, and now they're trying to figure out how to get out of this thing. With the markets already closed for the evening, and it could open up even worse tomorrow morning for them. So we have a couple of charts that show price. Here's the problem with price. Number one, very hard to predict futures prices from earnings announcements. I mean, you would agree here, right, Mike?
yeah, no question about it. It's
I mean, take a look here. You've got
go up or down. I mean, you look here at Amazon, the earnings to the left there, the stock tanked, and then it went up a few earnings, and you just don't know which way it's going to go. So to get in that game of predicting direction on an earnings announcement is pretty treacherous, quite frankly, and frustrating for most.
It is. And now we'll show you a couple other charts here. So here's Green Mountain Coffee Roasters. All right. Had one of its best earnings announcements. And this chart was a chart from, I think it was about a year or so ago. But look at this. Good earnings, drop. Bad earnings, drop. Bad earnings, drop. Good earnings, drop. I mean, how do you play that? If you're going to
win that?
You can't buy the stock. God forbid if you bought the options, because now you got price and time going away against you if you were trying to buy puts or calls on this thing. And then you got, an example like SanDisk, where you had good earnings and it really kind of moved nowhere before finally moving higher. You had good earnings, and again, it dropped down, back up, and then nowhere before kind of gyrating. Here's good earnings. We had a little bit of a pop, and then we started to move, or drop, and then we started to move a little bit higher. Of these four, this last one had a move that looked like it might have actually worked for a call option trader for one day. But you know what? After buying here and here and here, what are the chances that you would have gave up on it on this earning before you finally got the winner? It's a very high possibility. Here's the problem. People that trade earnings on price are what I like to call intuitive traders. Intuitive traders are thinkers. They're creators. And as great as that sounds, it doesn't work in the stock market. All right. I think it's going up, or I think it's going down. There's no way that I can back test intuition. All right. But, Mike, what about using the power implied volatility?
Yeah, now this is a pattern that's extremely reliable and doesn't matter which way the stock gaps or if it gaps at all. So we're going to talk about implied volatility, and that's that heartbeat pattern I was showing you earlier. Tom, can you go to the next slide? Let's take a look here. So remember, on some stocks, because they tend to gap, option traders come in and they buy options up into the earnings announcement with the expectation the stock's going to gap, and about 1/3 of those traders will actually make money. So, but here's the good news. The demand for the options, which is represented by the red line, we can call it implied volatility. We can call it demand for the options. And demand translates directly to the price of the options. So here's an idea. How about we ride these red waves? How about we get in at some period of time before the earnings announcement? We'll buy a straddle, and then we'll get out before the earnings announcement to avoid any risk of the stock not moving enough. So that's the basic strategy. It's a very few people trade straddles in this fashion. Most are trading direction. We're smart though. After all the work we've done behind the scenes, we're actually getting smart. We're mitigating our risk, bringing the amount of risk down, and we're placing these straddles for 5, 10, 7, 20 days, usually around 10 days. We'll get in before the earnings announcement. We'll get in, we'll get out, and we'll make our money without experiencing a directional risk or volatility crush. So, and these spikes, again, are in concert with the earnings announcement. So the idea is we're playing earnings. We need to figure out when to get in. We buy a short-term straddle, and we get out before the announcement.
Right. Now, I'm going to play devil with that. Oh, let's look at a couple more charts. So here's Amazon. Same concept. Up before,
Yep.
down after. Here's SanDisk. Same concept. Up before, down after. So I want you all to think about that event we just talked about. All right. I want you to think about the ticket prices at the Super Bowl. And as we get closer and closer and closer to kickoff time. And then once the kickoff happens, boom, the prices drop. Wouldn't you rather get in down here when you can first get your hands on some of those tickets and at face value, and then get out as we move up the curve here before the game even starts? And now I want you to think about the game being the earnings announcement. Doesn't it make sense if you see this pattern happening over and over and over and over again with certain stocks? It makes sense to get in on a non-directional trade, and you're playing the volatility now. You're not playing the price. You don't really even care what price does. What you're looking for is this crowding effect that always happens, and it does happen with every stock, but it happens to a degree where your time value actually goes positive for certain stocks. Right? Wouldn't it be great if you could get in and then you get out right before the kickoff, right before the earnings report? And so that's what we found. And this has kind of been 10 years in the making. That's what we found when it comes to these earnings trades. You know, and I had a question that popped up that said, "Hey, Tom, I thought you used to trade straddles where you took the 90-day option, right? These short-term options, aren't they more risky than a 90-day option?" Let me answer that real quick. All right, 90-day straddles where you're taking the call and the put over 90 days. You're not trading an event. You're trading expecting price to outpace what you paid for that straddle. All right, that is a longer-term trade. What we're talking about is something short-term where you're getting in at a sweet spot and getting out and making 10, 20, 30, 40% without market direction and then moving on. All right. So when I look at straddles, I'm not looking for a double in a straddle, because doubles and straddles, if you get a 50% move in a straddle, all right, that's fantastic. That meant that both options increased by 50%, or maybe one option doubled in value and the other one dropped by 50%. So what you're looking for is a something that's going to key off the future event, not price, but the future event. That's what volatility here is all about. And so, to kind of sum this up, Mike, we're buying. If we got these green and red lights here on the chart, this could be any chart, but you're basically buying before the hype, and you're selling at the height of the hype.
Yeah, pretty much. We might even find ourselves buying in the midst of the hype, depending upon when we get our entry signal. But yeah, that's the basic idea. Buy and ride the demand wave. I've been running this class for 2 years now, and I just wanted to give you some sample trades. And these are short-term trades. Gilead Sciences, on April 21st of last year, we entered in Gilead Sciences short-term straddle, and in 7 days, we sold the straddle before the earnings announcement for a 31% profit. Now, Tom, that's not bad in 7 days. I don't know how you do, but I'm pretty happy with 31% in 7 days.
Without having to deal with market direction, that's fantastic.
Yeah, very little risk whatsoever. Yeah, because of that implied volatility is rushing in, it really does an amazing job of keeping our risk at bay. This strategy has a very low risk profile. Here's one, April 22nd as an example. We entered an Amgen straddle 6 days before the announcement and exited for a 15% loss. Now that, ladies and gentlemen, is on the high end of loss. So our losses are generally between 5 and 10%, and our profits are generally around 30%. So, this is really the beauty of the strategy in that when you're wrong, and you will be, every strategy you're going to be wrong, right? So when you're wrong in this strategy, you're just not going to lose very much. That's by far the best part of the strategy, in my opinion. On May 13th, we entered Best Buy 10 days before the earnings announcement, exited for a 39% profit. Again, in 10 days, that's pretty phenomenal. We got
And
some more on the next.
and keep in mind too. You might say, well, how come you're not having? This is just a small sample of the trades that Mike had on, and he's going to show what he's done since his last class. Now, the class he's talking about is something that we call our mastery series, and Mike teaches a mastery series course once a year. It's not something we do all the time. It's a once a year class. It just so happens that this is the time of the year that we teach it, right at the beginning of earnings season, for the beginning of the year. So that's one of the reasons I have him here. But Mike, tell us about these other three trades real quick.
Yeah, here's another example of a really small loss. This was an Akamai on July the 20th last year. We entered, and then on July 20th, 6 days later, we had a very small loss, -3%. Again, losses are contained in this system. On September 22nd of last year, we entered McCormick, and then 6 days later, we had a 9% profit. So not all the profits are not around 25, 30%. Some of them are 9%, some of them are 2%. I'm going to give you a track record here in just a few minutes so you can get an idea of what the averages are. On November 4th of last year, we put a Nordstrom straddle on right before the holidays, and 6 days later, had a 31% profit.
Awesome.
So this is the kind of world I'm living in now, Tom. I like it much better than my naked put days.
And you know what? There are some students that are in here that were at your class last year, and I actually grabbed comments from them, and I'm going to share those with everyone here. Now, the one thing I want to mention is that this is based on the scalping red wave strategy that you have. Mike actually has a couple of different strategies, kind of before, during, and after earnings. But the one we're focusing on right now that we're showing you is I kind of call it the ticket scalping strategy, but Mike calls it the red wave strategy. So, I noticed also 6 days, 6 days, 6 days. I mean, you're not in these for very long. So when the question popped up that said, are you buying, where was it? I saw one that said, are you buying 45, what type of options are you buying? 45 to 60-day options. I thought I saw it on the screen. Yeah. And the answer is, really it kind of depends. You're buying these options you're buying expire just after the earnings expiration. So
these are weeklies.
Yeah.
I mean, talk about traders gone wild, Tom. I mean, we're trading options that expire the day after earnings. Maybe it's a week after, but we're trading weekly options, 2-week options. We're trading short-term options in order to capture as much implied volatility as we can on the demand curve, on the red wave as it spikes in.
Right, but Mike, how could you do that and not lose money? I heard, if you buy weekly straddles on weeklies, isn't that a death sentence?
It is a death sentence unless the implied volatility rushes in, and that's what we've uncovered. All the coding behind the scenes, we have detected the stocks that have the best IV rushes, the best demand rushes into earnings, and these spikes are so big that they offset the traditional risk of time decay in weekly options. And with weekly options, you make more money.
So here's
They
your
make more money than longer term options.
so here's your performance since your last class that you did that ran in February and March. I remember last year you started in February, you ended in March, and so you started showing your trades since then. April you had 8 trades. There were 5 winners and 3 losers. May you were 4 and you had 2 and 2. June 2 and 3. July 7 and 13. You had a couple of losing months there, but I see them. They're not much. It's 5%, 2%. But then August, September, October, November, you were on fire.
Yeah.
With September being the best. Now, also, when are earnings typically announced? They're typically announced like Jan, Feb, right? Um, uh, April, is it January, February, and then April, May, and then
Every 3 months after. Yeah.
yeah, about it's every 3 months, and it usually starts. With the calendar month being January, mid-January to mid-February is really the sweet spot. So there's some areas in here where you had like July 20 trades, October 10 trades, September 9 trades, and then there's the months where you only had 4, because that's just not the bunching time when earnings happen. But you do have trades for earnings trades that are happening every single month. I see that.
Yeah, that's right. Absolutely. Yeah.
The other thing is
Absolutely.
your winners are outpacing your losers by about 3 to 1. I see that.
Yeah. Tom,
Uh,
I just want to throw something in.
Please.
Guys and girls, $184 average loser to 537 average winner is phenomenal. Now I position size my positions to 2,000 a trade. You can get into these straddles for $200. I mean, they're not expensive. Remember, we're buying weekly or sometimes 2-week options, so they're not that expensive. They don't cost that much, so you can get into these trades for $200-300 sometimes, $500 sometimes. But the point is that when you're wrong, look at the 5 and 2% over here as well, Tom, that you mentioned.
Yeah.
That's having a losing month of 5%. That's your biggest losing month in a year. Phenomenal. Phenomenal. And this system is rote. It's rule based. There's really not much to think about. You follow the rules. You press the button, get the trades, and this is what it produces.
That's fantastic. I'm just kind of cycling through with some of the comments, and I've got some of the comments we'll have on the screen here in a moment. But I mean, putting them on, one of the guys puts them on 18 days before on average. One of your students is making 5% a month on average doing this particular strategy. And 5% a month may not sound like much, but if that's 60% a year, that's more than any money manager that I know that's making money.
Compounded, it's more than that, right?
I mean, yeah. More. Here's another one: more winners than losers. Here's Ron. Ron says traded straddles in the past with Optionetics, but he hasn't been doing them lately. And Ron, I can tell you, what was being taught at Optionetics was the 90-day straddle, which was based on price movement. This is something completely different. And so, that's something I want to make sure. Here you go, doing well. Made a killing on Nvidia last year. Love it. Been waiting for a dip before earnings, then we'll pounce on this one again. So that's a couple of them. I've got more to talk about as we finish up. But and Mike, I just missed something there, and you said it already. But $537 win, average winner for every $184 average loss. That's a nice compounded return that you got going on down there, my friend.
Yeah, if we annualize this, if we keep going at the pace we're going, we'll have a 42% return on this portfolio.
That's fantastic. And you're never at a loss for trades, but
Yeah.
we're always very nitpicky because you're looking for and guys, I'll give you an idea what Mike does is that he's looking for that red wave movement and getting into those, but we're back testing to these as well. And we look for back tests, that in a lot of cases that are 75 to 100% back tests in the history, because, history does for us, we look for patterns of history to continue into the future. And so we won't take a straddle if it's showing back tested showing losses. We'll take straddles based on back tests of profitability. So, Mike, earnings plan for 2017.
Yeah, so we have some software, and when I decided to take this on, I was looking at uh, I back tested a handful of stocks and trying to figure out the best time to get in. And one of the issues that we need to solve is what day do we get in before the earnings announcement to avoid dealing with too much time decay. It's a very complicated mathematical question, or the solution to it is very mathematical. So we got the best tools in the industry, in my estimation, and I've seen a lot of them. We got a great guy in the back that two or three guys that really they're really rocket scientists, and we've got some powerful stuff back there that's just crunching through lots and lots of data, looking for these patterns, looking through 500 stocks or even more than that if you choose to, but usually the S&P 500. And we go out and we look for stocks on a stock-by-stock basis. We look for the optimal time to enter for each stock. So for each stock, for up to 8 earnings periods, we go in and we test a whole month worth of entries prior to the earnings announcement, and we figure out which is the best time to get in. So it's a brute force number crunching scan that does all the hard work for you. You press a button, back testing is done for you, and you're presented with those stocks that have 100% historical accuracy. You literally just have to press a button and take the ones on the top.
Right.
It's really powerful.
Mike, the other thing too is that, it's, it is easy, but it's also important to understand what's going on behind the scenes and really understand the whole methodology itself. Even before you start pushing buttons, you really got to understand this stuff, because to me, it's like, I told this story the other day. So I got my wife a Tesla for Christmas. All right. There was a certain model that she wanted, and we test drove it. And I got to tell you, it is going to take probably a week of reading the owner's manual to understand what this thing does. You can't just get in this car and start pushing buttons, even though it literally will drive you anywhere you want to go. For me, I still want to understand the workings behind the buttons, behind the automation, the self-driving automation, etc. I need to know that stuff before, it's going to make me feel more comfortable in the car. Just like that, if you're presented with these different advanced trading buttons that we offer, we only offer these to our mastery students, because they understand the inner workings of these buttons and they feel comfortable with the strategies, so that they know in a lot of cases what's coming up before the scan gives you results. And so this time, you know what we can do, Mike? You've got a real-time trade you want to show everyone that basically goes through exactly what you're talking about. Now, will you need to steal the computer from me?
Yeah, what I have to show is an example, so I can show everybody the inner workings. That's really important for everyone to understand. It's not just, as you point out, Tom, just press a button. You do need to understand how implied volatility works and time value works, and there's a selection process. So I thought I could just show an example of that.
Yeah. Okay. So the trade is Gilead. And do you want me to turn it over to you, and then you can kind of walk them through this, or what you want?
I don't have Gilead loaded in my tools. I've got some other case study examples, but I don't have Gilead. I could show a past Gilead trade.
Well, let's start with Gilead. You have it up on the screen here, and this is something that we're looking at that's based on the red wave pattern. And so, go ahead and walk us through this, Mike.
Yeah, this is an example of what comes out of the scans, and Gilead has been a darling for us. Last year we had a 1 or 2 trades on Gilead that turned out to be really, really great. But what the software does is goes out. In this particular case, you can see it's gone out, and I can't point from here, but if you look at where it says win percentage, Gilead over the last 4 earnings periods has worked 100% of the time for an average return over those 4 earnings periods of 27.32%. Now, so this is the red wave straddle. This is what comes back in the scans, and it then gives us a buy before earnings date on the left there. So this one is entering a Gilead straddle on the 31st of this month. This is a live case study, everyone. This is something that's on my radar screen. And then we get out of this trade 7 days later on the 7th of February. So this is a case study that we'd like you to maybe paper trade. So the 7 calendar days is the optimal time to get in, and that's really critical to understand. The software determines through historical number crunching the optimal day to enter before the earnings announcement. So the software gives us that.
Let me, before I turn this over to you, Mike, let me make something very clear here. Okay, so this is an example as if today was the 31st, with this particular stock being around $72, the 72 call and put would be a great example of how to do that. All right, so that's the 72 call and put, and you can see right here it's going to end up costing somewhere around $4.38. All right, and this would be
$438.
Yeah, $438. This would be an example of what action we would end up taking on this. But guess what? Today is January 19th. We still have a couple of weeks before we get to the 31st. So on the 31st, what could change? Oh, let's see. The stock price could change, which means if the stock price changes, then we have to go with the at-the-money straddle on the 31st, not today. All right, I'm just simply showing you an example of what this looks like if today were the 31st. But on the 31st, we're going to be looking at buying that at-the-money straddle, all right, during the last hour of the day. Then our exit date is going to be February 7th, and you're going to sell to close the at-the-money straddle. Guess when? The last hour of the day. Right here, we're not going to see as much hype on Gilead as you're going to see on February 6th, or excuse me, February 7th after market close. You want to be out before market close of February 7th, because right after that, about 15 minutes later, Gilead is going to announce its earnings. By then, the planes have flown over, the kickoff has begun, and you know what happens to those tickets when you can't get back can't sell them until after halftime, which would be the open of the next day for this particular stock. You'd see volatility drop. So, Mike, let me turn it over to you for a few minutes, and you can show a few more of these things on your screen. So
yeah,
I
definitely.
am going to find you in here. This is a big group of people. Luckily, it's all sorted by first name. So I just got to find you in the minutia. And did you change your? You didn't change your name. There you are, right there. All right.
I should be in the top part.
I'm hoping this is Mike Wade that we're seeing here.
Yeah.
Yes, it is.
Yeah, I got it. So I just showed you a Gilead trade, and I want to show you one that I did last year in 2016, just to give you an example of what you might expect going forward on this case study. So this was on April the 21st of 2016, and again I ran the scans, did my analysis, and I picked out Gilead, and we bought we spent $2,000 on this trade, but remember, I'm buying 5 contracts. To get into this trade would be $424 a straddle. So we entered the trade, and we spent $2,000 because we bought 5 of them. And you can see here on the right is the risk graph. It's pretty much perfectly centered. We're expecting the stock to. We don't really. It's nice if the stock moves, but it's not necessary that the stock moves. So what normally happens, so if the stock did not move, whether it did or not actually, what's going to happen over time is these colored lines are going to sink down into loss. So time decay kicks in as you're waiting for the earnings announcement, time's working for you. But what's working for us that will offset the impact of time decay is this gorgeous IV rush pattern. So we're expecting, and we're right, you can see here the red wave is starting to rise as it did over here. So we're entering Gilead in enough time to capture some IV rush. Notice we're getting in 7 days before the earnings announcement. And ladies and gentlemen, we're buying 8-day options, which means that these options expire the day after the earnings announcement. Yes, I said that. We are buying 1 week options, 8-day options. Now, that violates most straddle traders' rules, but because of the power of the system and the power of the software, we know this works. Not many people do, Tom, right? This is a very proprietary system that we're sharing with you tonight.
Oh yeah,
So keep it
absolutely.
to yourself.
Absolutely.
Yeah.
Any others you got?
Well, let me show you what happened. I want to show everybody what happened with the trade. So I'm
Yeah.
going to go ahead and duplicate this, show you the impact of the IV rush. So the earnings date here was on the 4/28 after market close. So we're going to get out of this trade no later than 4 p.m. on 4/28, and I'm going to go ahead and change the counter to 4/28, and let's see what happens. What we're expecting is the IV to rush in, and you can see that the IV did rush in, and it impacted my trade. Actually, that's 1 day too long here. That's right. The IV rushed in, and we ended up with a nice 30% profit on that trade. Here's another one on Best Buy. I like Best Buy. We got into Best Buy on 5/13, 2016. Look at that gorgeous IV rush pattern. So we're going to ride the red wave. And this is a good one. I want to show you what happens to the colored lines, or the theta lines. Let's go to earnings, to the day before earnings, which was on 5/23. And I want to show you something that's just beautiful. And this is what I love the most. So look what happens to the red line. All the lines, the red and the blue line, are now safely in profit. So what's happened is that the IV here has rushed up so much. It rushed up so much that it made the options super expensive and even offset time decay, which would have normally moved these lines into loss. Look here. The stock is here. If the stock goes up, we continue to make money. If the stock drops, we'll lose a little bit, but we'll still make money. If it keeps dropping, we'll make even more money. So these red lines, these colored lines, are pushed into profit by IV rush. And Tom, that is a classic example of the power of the system, where we find the stocks whose IV rushes enough so that it offsets time decay, which is a killer for straddles.
Yeah.
So I could go on and on. I've got tons of these. I love them. I'll show you one that lost money. This one was on Akamai, and again, same system. We're getting in 9-day options. We're going to get in 6 days before the announcement. We got a really just beautiful IV rush. In this particular case, let me take you to the exit on 7/26. So on 7/26, the IV did in fact rush, but it didn't rush enough. We ended up losing about 3% or so on the trade, and you can see that that is still awesome. Look there. That's the worst it could get for us is what we lost. There's no 5%, 10%, 100% loss in this trade. The IV has pushed these color lines into profit. That is what is so beautiful about this system. The IV rush is what keeps you from losing much money. Yeah, you're going to win 50, 60% of the time. Your winners are going to be in the neighborhood of 25, 30%. Your losers somewhere in the neighborhood of 10%. And you're just not going to lose. You can sleep at night with this strategy.
Yeah, I mean, I say it, but I know it really is an amazing strategy, and you know what? I want to show a couple more comments that were coming through. So let me grab that screen back from you here. Before I do, though, any questions, comments? Jay, are you seeing, Jay, if you could look and see if there's any of the popular questions that are coming up. If you do have questions or comments, now be the time to ask them. As we're waiting on those, as Jay's pulling those together, real quick, let me just show you some comments here. So this came up, Mike. This is my beauty rest strategy. I can sleep well no matter what the market's doing. Another advantage of the strategy is not only the absence of sleepless nights, but it does not require you to be in front of the computer daily, and you can set automatic exits based on profit targets. How about this one? Can we get the SEC to require earnings every 2 months? More excellent opportunities.
I like that.
I thought you'd like
How
that.
about every month?
Yeah. Straddles are traditionally thought of as expensive since purchasing calls and puts. These are traded easily with account size less than 20K, hypothetical even less than 10, because the scanner selects only the best possible candidates. Great scanner. If I have a system over the long run that can win 2 out of every 3 trades and my winners outpace my losers by 3 to 1, there's no other strategy that I would rather be doing. And I think I'm going to end it right there with that one.
Yeah.
Questions, Jay?
Uh, do the tools or is there a list in the scan, or does the scan find the list of the stocks to trade, and does the tools also suggest what's the best date? Because that's what they're kind of asking for. How do you know what strikes and what's the best date to choose?
Well, that's
Yeah,
all
the
built
software.
in.
Yeah,
Yeah,
it's built in. Software
that's all
does
built
that.
in.
Yes. Yeah.
And it's built in based on the education and the knowledge that Mike has garnished over the last 10 years. So as he teaches this, and what we're talking about here is something called the 2000. We're talking about the mastery series we do once a year, which is a multi-week course. This is not a 1 day or 2 day long webinar where Mike comes in, teaches, and then he's gone. This is a long-term program that will teach you over the entire earnings season how this works with real-time case studies from the beginning of earnings season to the end. And then the software really does do everything for you. It brings it all the way down to the stock list that you trade, the entry date, the exit date, and then it'll even show you optimals based on the past. Right? Obviously, there's going to be a list of stocks. It might be a small list, but it's still a list. And Mike's also going to show you how he will rank that list from the ones that he loves the most. If you were to trade 1 or 2 out of a list of, say, 4 or 5, which ones are the top trades? He's going to be able to show you how to rank that and how to actually scan that himself. What else do you have there, Mr. J?
Well, another one that just came in is this class a live trading room, or is it a class and you use your scanner on your own? And it's a live educational room.
Yes.
But
so they're not videos. What they are is they are this is a 5-week course. I have it up on the screen right now. This will be our 2017 straddle and strangle strategy, and Mike's going to talk about when and how he uses strangles instead of straddles, what they are and how to use those. All right, you'll see how they work from entry to exit. What you're going to do is this is live. You don't necessarily need to have it live with the markets, and I'll tell you why. Because once you learn this system, you're going to be able to have a calendar, an earnings calendar, with when you're going to be putting a trade on and when you're going to be taking a trade off, based on the information you've learned. It's like a scouting report. That's what I like to call it. It's an earnings scouting report where I immediately know on future dates when I want to be looking at earnings strategies for specific stocks. Mike, did I leave anything out on that initial idea of what the program's about?
Yeah, that's a good encapsulation of it. Yeah.
So we started on January 25th. That's the piece that I wanted to let you guys know about. All right, January 25th is the strategy. Mike, do you want to talk a little bit about the actual curriculum and
Yeah,
what
sure.
we're doing here? I mean, this is just a few lines of what it is you're planning on doing. And by the way, I'll let you guys know the cat's out of the bag. This is going to be more than 5 weeks because Mike's got some new stuff for 2017, which he's going to be adding into a bonus week. So, Mike, let them know
Yes.
what this is about.
Yeah, the first week and hasn't got all 6 weeks, but we're going to get into straddles and strangles and what they are and how they work and how does IB impact them, how does time decay impact them. So you can really get be masterful at reading a risk graph for straddles. We'll look at the Greeks, understanding delta, gamma, vega, and theta. And by the way, don't worry about the Greeks. It's maybe intimidating for some of you, but it's really nothing more than sensitivities. So we'll talk about what those are. You'll be very comfortable with Greeks. We want to look for IV rush and find the very best IV rush patterns and how to profit them before the earnings announcement. So we've given you a clue about that tonight. We'll look at positioning short-term straddles to surf the red wave. I've showed you a couple of examples of that. I'm going to show you how to find those, right? We're going to backtest and identify optimal entry and exit dates for the stocks that actually work 100% of the time. We're going to be using IV rush candidates. We're going to be detecting the best IV rushers, the best red wave spikes, the biggest ones. We've got a scanner to help us with that. We're even going to get into the world of breakouts, and we're going to show you how to find breakouts straddles that work 100% of the time, at least over the last 4 earnings periods. So although breakouts they can be a little more risky because you don't win as often, with this tool and with our techniques, we'll actually find the very best breakout candidates. They're great because when they do break, you can make a lot of money on a breakout. So the class also mixes in breakouts. And while we're doing that, of course, we're avoiding the impact of IV crush. And again, identifying the optimal entry and exit dates. The software does that for us. Delta neutral adjustments to lock in profit. That's really something that is vital to a straddle trader. So when the profits are there, I'm going to show you how to capture them, lock them in, so you can put the cash in your pocket and keep playing. So and there's a lot more. I could talk for 2 hours on what's in the class, but this gives you a little taste of what's to come.
Yeah, so let me tell you about the entire overview of this class. So this is a 5-week breakout mastery course. We call it Straddle Mastery. It's actually going to end up being 6 weeks, where we're going to, if you get an idea, red wave scans. Mike's working on something called blue and black wave scans, which are going to be included in this class. All right, with this group. All right, for the 2017 group, we're going to include that. So we'll talk about what those are. Seagulls and TLJs, which are a different type of trade, are also going to be included. The whole course is wrapped up with, now we're calling it 6 weekly 90 to 120 minute live online classes. All right. 6 months of access to the recorded session. So in the event that you can't make a live session or two, or in the event that you need to look at it over and over again, that's what the access to recorded sessions will be. So we're going to give you a unique link, and you'll have the opportunity with that and a password to view those for the next 6 months. All right, live case studies throughout the mastery series. So one thing Mike's really good at is not only does he teach this, but he's going to be giving you his live trades. All right, you're going to see these live trades, and you're going to see them ahead of time from entry to exit during the course of the mastery course. All right, what we're doing also is we are going to give you access to the Straddle Mastery scans. I'll show you that in a moment. All right, part of this course includes a forum where you can talk directly to Mike and other members of this group. And so we're going to upgrade your forum. We're going to give you forum access to talk to Mike. And of course, this comes with live support through direct phone, through Skype, and through email. I think we're one of the only groups around who, when you call, you're not getting the press 1 for this, press 2 for that, chat here, go to this website. You're getting us, and if you get a voicemail, leave us a message. We call you back. All right. I got enough people who've gone through this and other programs that we've offered that can attest to that when it comes to our live support and how fast we get back in touch with you. So this also comes with the Straddle Trapper button. All right. And the Straddle Trapper button is a series of buttons. And so very quickly, we have what's called Surf the Red Wave. That is the foundation for what we talked about tonight. Finding these red waves before they move up and giving you those ones that have worked time and time again, up to 100% in the past, right? Those make it real easy for someone that likes rules-based trading to say, oh, here's something that works over and over and over again. I'm going to do that. All right. We also have something called optimal straddle, and that's going to be a way where you can take your entire red wave scan and you can drill that down to individual stocks, and you can find out exactly the best date to be buying and the best date to be selling based on historical backtesting, looking at implied volatility. All right. And so that'll find those optimal days to enter the straddle so you can surf that red wave and survive theta decay. And then finally, we have the breakout straddle, which is also built-in historical backtesting. This is a little bit different. This one's based more on technical analysis, but it too has backtesting. and we can find straddles that have the best breakouts and survive the IV crush. And Mike was telling me earlier today that Nvidia is right now hitting what we call the breakout straddle. So it may be a breakout and a red wave straddle over the next couple of weeks.
That's right.
So there's that. Now, I got a couple bonuses that we're going to be adding in because those of you that are in here listening are new to us and have not taken a mastery course before. So one of the bonuses we're doing is we're adding in that 6th week because we want to make sure that that Mike has plenty of time to where he's not feeding you like a fire hose with new information. I want him to make sure that you understand it. All right. And Mike has carte blanche to talk as long as he wants. And we've had some of our sessions have gone on for 3 hours or more. Now, there comes a time that I know that, sometimes too much time is not good, but I want to make sure that everybody understands it. And that's why we're also, adding in the forums to be able to talk to Mike. But you know what else I need to do? I'm going to add in a complimentary subscription to our tools. And not just any tools. What we're going to do is we're going to give you a professional subscription to our Pro Tools. And you'll have this, which will include this series of buttons, where you'll be able to click the straddle trapper button and be able to take what Mike has taught you and be able to move forward. And what the scan buttons are for is to do the work for you and to create efficiency once you understand the strategy from beginning to end. That's what it does. So the straddle trapper button is included. We're also coming soon. We're going to have black wave scanner, blue wave scanners, and those buttons will also be available to you for those of you that are signing up for this particular course. Final bonus is we're doing a money back guarantee. I want to make sure those of you who are thinking, this sounds really interesting. I don't know if it's for me, but I'm very interested in it. So here's the deal. All right. Sign up for for the program. Attend week number 1. All right, which is going to be next Wednesday. We start this class next Wednesday, and this will be a 6-week class. It's the only time this year it's going to happen is now. It's not going to happen in the middle of the year. It's not going to happen at the end of the year. Mike doesn't have time. Mike's time is now. So you can join us for week 1 if you're not satisfied after being with us for week 1. Let us know 72 hours within 72 hours of the live event, and we'll send you a quick and full refund. No questions asked. Okay? So you might be wondering a little bit more about the price on this thing. So with the bonuses we put together, this particular course, this system mastery course, all right, regular price on this is $2,490. But now I'm adding on some bonuses that are putting this well above $3,000. What we're doing though is we are doing a new student discount, which includes the bonuses, and we're going to do this for $19.95. Now this is only going to be good now it does say good between now and midnight January 23rd, which is Sunday, but here's the problem. I only have 20 spots available for new students. All right. I had 25. 5 are gone already. All right. 5 were gone before we got started. So I got 20 spots left. And so once we hit spot number 20, this link is no longer going to work. This link is not something you can find by just typing in tomgentile.com and surfing around. You have to have this link to get in. And I put this link in the chat room for all of you to be able to take a look at this. If you go to the chat box, you'll see www.tomgentile.com/straddle mastery. If you click on that, it's going to bring up this special page, and this special page shows you the price that we're doing. All right, and so we've got our special price. Regular price was $24.95. I'm adding the bonuses on top of that, but I'm also slashing that down to $19.95 for those of you that are interested in this and that sign up. If you're one of the first 20. To sign up for this, you can see all the information that I just showed you, including the bonus, including the money back guarantee, all of the information that comes with this, the bonuses that put this up around $3,100. Like I said, if you're interested, click on the sign up now button. There's a terms and conditions that you may want to read. Once you've gone through that, click on I agree. And at this point, you're going to go into one of 2 areas. If you already have PayPal, you can log in with PayPal. You'll see the discounted price is already up here, $19.95. That will be for the first 20 people. Once we get past 20, you won't get this far. This is it. All right. If you don't have PayPal, and I get this all the time, I don't use PayPal, Tom. How can I pay without PayPal? Come down below the blue button that says login. Down here it says pay with debit or credit card. Click on that, and we give you a way to just use a debit or credit card. You put the information in. It's called the guest checkout, and fill out the information. And if you don't want to have an account, stay at no. If you want to have an account, you can open up a PayPal account, but it doesn't matter to me either way. All right. If you have PayPal, great. If you don't, you can still come in, pay now, and that will take you in immediately upon your payment. You will get a confirmation email from me welcoming you to our 2017 Straddle Mastery. All right. You will also get access to the registration for week number 1. I would suggest you read through that welcome email because it's going to have a lot of information. We've got a PDF file out there showing you the entire course curriculum. We have the registration for week 1. We talk about the software. We give you the numbers for support, all right, for our trading support, which is both our direct lines, our Skype address, and, of course, our email address. I'm going to give that email address out tonight. But that's it, guys. That's the program. All right, so we certainly hope that you can join us. If you have any questions, before I open this up for a few questions, if you have any questions you want to contact us about regarding either the actual Straddle course, anything about what Mike and I discussed today, or maybe you want to ask us about the offer, let me tell you where you need to go. Support at tomgentile.com. Again, support at tomgentile.com. I put it on the screen there for you. Jay, are there any pressing questions or things that I may have overlooked?
They're asking about the scan only.
Scan, we do not offer the scan without the course. All right, the scan is proprietary to Mike, and the only way you end up getting the scan is if you get the course. Once you've taken the course, the scan is yours for life, providing that you are a tools member. All right, providing you use our tools, we're not gonna you don't have any additional upcharge at all on the scan. All right, but it's kind of like jumping into a fighter jet without knowing how to fly. So Mike is there for the next 6 weeks to teach you how to fly, and then from there, you are then released with you'll get the buttons activated on week 2, because we're going to cover fundamentals on week 1 and the actual strategy itself. Week 2, you get the buttons. In week 2, 3, 4, 5, and 6, Mike will be showing you the different buttons. By the way, there's more than one. There's several of them that encompass the Straddle Mastery, which is why you got to take the course in order to have the buttons. And I might also answer this, is that as we develop and add different versions to these buttons, those people who are Straddle Mastery students will get the updated versions. All right, you won't have to pay for any updated versions. It comes with upgrades to those particular buttons. All right, Mike, any final comments from you, my friend?
No, it's just this has become my darling. I've been looking since I've been teaching at Optionetics since 2002. Then most recently with Tom's Trading Room. I've always been on the lookout for a strategy that I think can really impact traders at all levels, from the beginner to the novice to the expert. This strategy works. It's been proven mathematically. It's been proven in action. I stand behind this, and I'm very proud of it, and I'm very excited about the impact I've already seen it have on our students' lives. So that's what I'm about.
You're on contribution. And you're on the discussion boards on a regular basis. So you're talking to past members too that were with you last year that still have access to you, even though it's not something that we guarantee, but we don't guarantee it after the course, but you've been on the boards for 2 years now, continuing to talk and continuing to educate people who took your class last year and in 2015. So, kudos to you.
Very active.
I mean, Mike is here to stay. He's excited about teaching what he knows to you. And again, we keep this class size small, guys. That's why we only have room for now less than 20 people, because people are signing up for this course. We have room for less than 20. And then after that, we shut it down, because there's only a certain number of people that we want to teach. There's only a certain number of people that we believe when we teach can get into these trades, with the particular type of strategy that it is. We already have partners who are ready, Mike. They are ready for January 25th. The folks that are taking the entire year with us. They're getting you, Christina, Devin, myself, Nick Gazzolo, and much more. They're already on board. So, between them and our members, we did have 20 more slots open for new students. And now's the time, if you're interested, guys. If you have any other questions, feel free to contact us. Thank you very much, everyone. Hope you have a great evening. Hope you learned something tonight. That was probably the most important thing. If we could really kind of have you walk away with something, don't just go out there and buy straddles because you think a stock's going to move. Have a reason for it. And our reason for it, we laid it out for you tonight. All right. Thanks again, everyone. Have a great evening. Recording will be out to you shortly, and I hope to see you real soon. Thanks again. Have a good night.